Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Hope you're having a great day out there. I get this question a lot. People say, rates are going up. Where do I invest? And, it's always the obvious. People think, well, let's go to gold. Let's do some inflation sort of thing, Bitcoin nowadays. And so think about it, though. If you're a fund manager, mutual fund, let's keep the hedge funds out of it. You're a mutual fund and you're running a growth fund, right? This happens to be my background, so I'm going to spread this out a little bit more today than the obvious. Do you have the opportunity to just go to gold, right? If you look at the objective of growth mutual funds, if they're feeling like rates are going higher, that's going to affect the tech stocks, and what do we do? They don't get to go to gold. That's not a choice. They can go to other sectors. They may be able to say growth in utilities or whatever it is, but they don't get to do some of these international type moves or gold type moves. And so let's just take that obvious thing out of it for a minute. I want to show you some different places you can look when rates are going up. Of course, this is going to, believe in the premise that rates will continue to go up, but I think a lot of us feel that way. So let's take a look. All right, what I'm going to share with you here first is we're going to use the 10-year as our benchmark. In other words, our barometer. We're going to look at this and say, can we agree that rates are going up, at least in the short term? Now, I'm looking back over 5 years here, but if I just zoom in, we'll go 1 year, and obviously we can see rates have gone up. You know it. You've been out there, likely you've seen some things here. Now, when rates go up, people think, oh, that's going to hurt utilities. All right, but we didn't ask the question, what's going to suffer? We asked the question, where can we put dollars, right? So utilities are the obvious one. Rates go down, utilities go up. That's what we believe. Let's look a little bit deeper here. So I want you to maybe think about this in pairs, and I'm going to talk sectors today. So when rates go up, yes, utilities tend to suffer. Doesn't mean they go down. They tend to suffer. But industrials outperform utilities. So we're really asking that question. If we don't want to be in utilities and rates are going up, which sector likely outperforms but has the same level of volatility? Remember, you're a fund manager in our example. You can't go to tech stocks. You wouldn't want to anyways if you think rates are going up. But you can't go to consumer staples, consumer discretionary, which I'll talk about in a second, because your focus is on where do I get the growth? So I need to know, I'm not going to go to utilities, but I need to know where do I go. So what we're going to do here is we're going to plot utilities against industrials. And we'll leave the backdrop of the 10-year rate there. So I'm going to change this. The 10 year is about 1.6 right now. So I'm going to change this to a percentage basis so we can see. All right, so when rates are moving higher, industrials outperform utilities. Just remember that. Teach your kids that, right? It's just basic sort of sector rotation. Utilities at the moment, since rates started going higher, I backed up to go 1 year because rates have kind of started going up about 1 year. We could go 6 months if we want to zoom in a little bit more to get to that point where rates started really going up. So from that point, let's use 6 months. Rates are going up and industrials outperform utilities by almost 20%. Utilities are up 5%. Remember, they don't have to go down because rates are going up. They're at historic lows. They can afford to go up. Utilities aren't going to suffer. You've got industrials up 25%. So if you think rates hit a bottom, rates are starting to trend up, focus on industrials over utilities, right? That's a pair. So let me give you another one. And what we're doing is just breaking down the market one way. So we're going to look at materials versus, where's my healthcare? There we go. So when rates go up, materials outperform healthcare. Both of them are not very exciting areas of the market, but you know this now. You can jot this down. 10-year rising. Materials outperforming by about 11 to 12% there, right? So that's that correlation. I don't know if you want to call it a correlation, but that's that ratio that you want to take a look at. One more for you. So this is kind of a fun one. When the 10-year is going up, consumer discretionary tends to beat consumer staples. Consumer staples are supposed to be non-cyclical. It's the idea that people are going to buy cigarettes and alcohol and go shopping and all that stuff for groceries and necessities in any markets at all. Consumer discretionary tends to outperform in rising rates there as far as sectors go. So you may want to stay away from utilities, healthcare, consumer staples, but when you need to know where the money should go or what you should do, that's one place to look. Now let's look at it a little bit differently here. I'm going to take this guy off and we're going to just do a pair. So we're going to put industrials versus utilities. And what we're looking at here is if the line is going up, industrials are doing better than utilities. If the line starts to go down, utilities are doing better than industrials. So for like this little window of time, not even a month, right? Utilities technically were outperforming industrials. Not outperforming, but starting to suffer. Anything under 1, I should have said it that way. Anything under 1, go like this. There we go. I can't go back far enough. So right now, you can see we have industrials outperforming utilities. As that trend changes, if we start going negative here, that would be the opposite. So that's one way to look at it. What you can do, you can just plot it on a chart if you want. Depends on how you want to look at it, but you can see the same thing. So industrials and utilities, with rising rates, we have industrials beating utilities. In other words, that spread is rising against the 10 years. So that's one way to look at it. We're going to do the same thing here, and I'll just put in materials versus healthcare. So I'll back out the 10-year for a second. Materials versus healthcare. It's the same thing. Now, they're not beating by as wide of a spread. See how we're only about 0.68 here versus what we had, 1.6 or something on the previous example. But we have a beat. Right? And we can do the same thing down here for consumer discretionary and consumer staples. So we have the same thing. This would be the widest sort of ratio out of all of them there. In other words, I'm just showing you this in case you go, oh man, I don't want to plot 3 different things. I don't want to go like this and have all this on my charts and everything. You could have 2 lines. You could have the 10-year, and you could have the ratio or the spread between the industrials and, let's say, utilities, if that's what you wanted to do. So there you go. That's a different way to look at it. I promise you no financial advisor knows that or really is talking about that. I guarantee you there's no other video like that on there on YouTube because it's not something that advisors tend to spend time on. We do because we manage our own funds. That's actually my background. That's my job, so I have to do that. But most financial advisors just pick a mutual fund or something. And I'm not saying they're bad. They probably help in other ways. But that's where you want to look. That's that thing you want to remember there, right? So we kind of all know the different basic things that we say about sectors. When one does well, one tends to suffer. But this includes with rising rates because we're going to be talking about rates for a while. You just know it, right? They're all over the place, man. So I hope you enjoyed that. It's a different way of looking at things. Let me know what you think. Do you like this sort of analysis? Because I could talk about this all day, but we kind of do the long-term investing thing, retirement thing. So a lot of strategy in there as well. Nonetheless, I just thank you for watching. Be sure to subscribe. I'm supposed to ask you that. YouTube, yay, whatever all that stuff is, helps us out. So I appreciate if you do that. And we'll see you later on The Closing Beat, 5 o'clock Eastern Time on YouTube. Enjoy.